Hi, everyone. It's Catherine Tindall. This is the Q&A session from last week's CPA Academy. We're just going to go through the questions here. Obviously, if you had questions that weren't addressed or more specific questions that you'd like a consultation on, our contact info is in the description box below. Our PEO submitted the ERC through an aggregated amended filing. Any idea how they would audit the PEO as a whole or individual companies under the PEO? Any guidance for companies using a PEO? So PEO, if you don't know what that is, you probably don't use one. Basically, if you have any other organization that's filing payroll tax returns for your organization using their EIN instead of your organization's EIN, you basically have to go through them in order to claim the ERC. They have to submit the filings, unless they want to share their EIN and have you do it. But there's really no way for you to track. You're really stuck with working with them. And typically, a lot of these have really large filings, so they don't get processed quickly by the IRS. They just go straight to examination. Now, I think it'll probably be a different treatment whether the PEO was doing the calculations and the submittal, or if they were just the intermediary doing the submittals and were relying on outside tax professionals to do the calculations for the organizations. And like I go over in the presentation, it's so idiosyncratic to each company whether or not they qualify that I think it would be difficult for the IRS to bulk audit these. I'm guessing what's going to happen is they'll probably do, just individual audits of the companies within a filing and not the filing as a whole. But I haven't been through a PEO audit myself, so we'll see. For a cash basis taxpayer, is the amended return due for the year it was received? No, it's the amended return is due from the year that you get the credit from. So if you're getting the credit from 20 or 21, those will be the returns you need to amend. Even though you're a cash basis taxpayer, it's just that weird code section 280C requirement that's going to force you to have to do that. So even though you're doing the filing, if you did the filing today, you're not going to get funding until 24 when they process it. You still have to go back and amend those old returns. If a new corporate entity was created during the 1920 period, would that preclude the ability to receive any benefits? So my first concern with this question is if it's just a new corporate entity and it's not a new business, so it's just a legal entity change, then most likely you're going to have an aggregated situation where you basically you need to treat it as if it was one business. So that would be the first question. And then the second question is, well, if it really is a new business and you don't have an aggregation issue, the first piece you're going to want to do is the receipts testing. And so I put the link in there for where you want to go for the rules for receipts testing when you have partial years. It's IRS Notice 2021-20 question 27, give you the guidelines for how to modify the receipts testing when you don't have a full 2019. And then in addition to that, if it started after February of 20, the business actually started operations and was a business after February of 20, then you're going to want to look at IRS Notice 2021-49 on the recovery startup business rules. They're different. If a business can be qualified as a recovery startup business, they can qualify for the ERC in Q3 and Q4 under, as long as they meet that definition of recovery startup business, which is extrapolated in that notice, then they're just going to qualify for the quarter. And then in addition to that, you also want to consider the government, the rules with the nominal portion of the business, like that segment closure, are going to be impacted based on, you don't have a comparative period in 2019 for the safe harbor, like I discussed. But if you've got, basically, if you have the nominal impact happening where the business was subject to restrictions and you do have a comparative period of what normal operations would be, whether that's pre-pandemic or post-pandemic, I think you can make that argument that those government restrictions, you would have to follow all the same rules. It's just the comparative periods that you'd be looking at would be shorter. And you also want to make sure that those comparative periods really are comparative periods, that is the normal course of business and not just, the business was starting up and operations weren't started yet. So definitely a needle to thread there, something I would recommend you get professional tax advice on. But, potentially, yes, under the recovery startup business rules, gross receipts testing, or the government orders, you could potentially qualify under any one of those. It's just going to be a little, tougher and more nuanced of a question because you have a business that wasn't fully operational during 2019 as a comparative period. I believe the presenter said you only adjust the wages on the amended income tax return. Why would you not also adjust the payroll taxes for the reduction in payroll taxes? The answer is because that's what the IRS wants us to do. So it's IRS Notice 2021-20 question 60 addresses this. You don't adjust the payroll tax deduction. You just adjust the wage deduction for the amount of the credit benefit. So there you go. Is there any exception regarding amending the tax returns for nonprofit corps? There's no tax impact by amending the 990. So the 280C requirement is a deduction matching a credit benefit requirement. And for a 990, as you know, is an informational return. So you're not actually deducting things on that tax return. Now, if you file a 990T where you have effectively income and deductions and you have wages that are reducing how much tax that the nonprofit is making, then definitely you would need to amend that. But on the 990, that would be a question for the tax professional, what their judgment call is, if you need to do an amendment or not. It's not my practice area. I'd be inclined to put it in as a prior period adjustment, but that's it's not, I don't think it's strictly required the same way that it's strictly required for for-profits. Would proceeds from the sale of an asset building be included in quarterly revenue for the purposes of ERC? So if it's a for-profit organization, then you take the proceeds less the adjusted tax basis of that asset. So that net amount is going to be what you add in for the gross receipts testing. Now for nonprofits, and this is crazy to me that it's like this, but it's a different code section that governs what's considered a gross receipt. And so you would just take the proceeds period and add it to the gross receipts. So you don't reduce it for the basis in the asset, which is crazy, but that's what they do. So those need to be included. Do you think the IRS is going to reopen the ERC after 12/31, or due to spam levels, they will have it closed for longer? I don't know that it's going to be because of spam levels. I think if anything, if they need an extension with the processing, it's going to be due to, they're just trying to implement more systems, but I don't know exactly what's happening over there. And when I talk to people internally, I don't get a sense of there being a lot of shifts and changes or developments of tools or things like that for them. I think it's just purely a wanting more time and maybe trying to scare off bad actors. But basically, at this point, everything has led me to believe that they will reopen post that 12/31 date, but will they be opening, full steam, flying flags and like moving quickly? Probably not. I think it's still going to be extremely slow, and they're going to have a huge backlog. And then also the other thing we need to watch out for is if you're submitting any claims for 2020, that statute of limitations is coming up in April. So even if you submit it now, it's very likely, in my mind, that those won't get processed until after April. So you definitely want to make sure that they have the returns as, the mailbox rule, that they're in for processing before that statute of limitations for 2020 claims, April 15th, 2024. So you want to make sure that you've definitely got proof that they've got those claims, because they may not be processing them until after April, just depending on, what their caseload is like and how much personnel they're going to allocate towards this. The other piece of it, which I also am inclined to think is going to make this go slower, is the fact that the income tax filing season is about to start after the end of the year. Early January is when they start that up again. And they're going to be allocating a lot of resources towards that, just because they can't fall behind on the current filing year in order for, to keep this really old program going. So I think it's going to be rocky for sure, but that's something, as we have more updates, I'll be talking about regularly. Can you get an ERC if the client only had 1099 contractors? From what I've read, I only see for W-2. What about if LLC and no payroll? So no payroll, you can still qualify and have an eligible period, but you're going to have no eligible wages, because remember, it's eligible wages paid, and payments to contractors are not wages. So you need W-2 wages. Now, if you had people that were incorrectly classified as 1099s that should have been W-2s, I could see potentially going back, if you correct that and correct it to, kind of turning yourself in, having those people be W-2'd, paying the payroll taxes, getting that all cleaned up, which may be the best course for you anyway, if that's the situation. Then you can, once you have that W-2 wages, you can, if you're eligible for the ERC, then it would potentially be eligible. But that's something where if you have people who are working for you and you're not sure how they should be classified, that's a very important conversation to have with the tax professional in general, because I've seen so many Blow-ups happen that can potentially sink businesses related to the payroll taxes and related to unemployment taxes when you have workers misclassified as 1099 when they really should be W-2. So that's something, if you're like on the fence of what these people are classified as, you'll definitely want to get a tax professional to assess that for you, because that can become a really serious issue beyond the ERC. But at least it's a cherry if you're going through the process of needing to correct that and reclassify people as W-2. That now potentially opens this program for you, under all the same eligibility rules, if you can reclassify those wages. But it's a pretty painful process going through that reclassification and catching up on all the other taxes. But that could be a help for you as well if you're in the process of having payments be reclassified as W-2 wages. You could potentially get a break on the payroll taxes and some of the penalties and interest there. This program can kind of help ameliorate some of that. So if you've been on the fence, maybe now's the time to fix it, but that's something to talk to a tax professional about for sure. If someone is a consultant that could not travel to businesses, airline issues, and plant closures due to COVID, would this qualify? So first would be gross receipts testing. And then second would be, you need to find what were the actual restrictions. Were they on the consultant or were they on other businesses, right? Because if they weren't directly on the consultant, then they're not being bound by that restriction the same way as, if your customer just decides they don't want to have you come, or you're not available to travel, that's not a direct order on your business. And that's why they have the revenue rules. And then the second piece that I would be interested in is, what's the nature of the consulting services that they provide? Because if they're not needing to be in person and they can basically do everything in a teleworking environment, then you're not going to meet the impact testing. So even if the restrictions were on the consultant themselves, if they're able to perform their work basically through a remote environment, the IRS has specifically called that out as, teleworking is not going to qualify. So that would be my question there. So those were all the questions from the Q&A. Thanks again for watching, and really enjoyed the session last week. Feel welcome to reach out if you have any additional questions for us, and do stay tuned, as I'll be continuing to post updates on the program, and as we're getting more guidance in some of these fun evolving areas with the administrative processing. But again, if you'd like more information about us and the work that we do and how we work for other tax professionals and organizations in this program, you can visit our website and submit an inquiry. We're happy to do a quick phone call and discuss if it's an appropriate program for you. Because, as you can tell from the way that I'm answering these questions, it's a very complex tax credit. Sometimes it's appropriate, sometimes it's not, and you just don't know until you look under the hood. All right. Thanks again. Have a great week, everyone.